Hey everyone, welcome to the final bar. Today on the show, we're going to talk about a market settling into its own through the course of the day. Really, the S&P finishing flat here on a Friday afternoon. We've had enough uncertainty, enough volatility leading up through today. So why not have just a little up and down, sideways sort of move? But I think there's plenty of signals still for us. The Nasdaq 100 leading the way lower. Technology, the worst of the 11 S&P sectors. Industrials, materials holding up pretty well. So we're continuing this cycle of small cap underperformance, market topping sort of configuration. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com. In a smoky Redmond, Washington, we're dealing with the wildfires that are plaguing the whole northwest part of the country here. So it's been a challenging couple of days with that, and certainly hope everyone stays safe. Again, now this is on 9/11, which is a challenging day for many of us. I think regardless of where you were, but I think for those of us in New York that had a lot of challenges and lost friends, colleagues, and others. Certainly wish everyone the best and think good thoughts for you on today and always. You know, as we think about the markets, this theme we've been reviewing in the last couple of weeks has been a general rotation. I wrote an article a couple of weeks ago talking about the market top checklist, and I feel like one by one we're sort of chipping away at those. And really, for me, the big signal is that weakening breadth, and that's the follow through that I think we're seeing today on a day that's flat, where it feels like sort of everything's okay. Maybe this is the end of a pullback. You still have technology leading the way lower. You still have small caps underperforming. So the breadth picture, even though today was flat, the breadth picture is going to continue to rotate a little lower as we review things over the weekend. So I think this certainly feels like a follow through from yesterday, even if the price was not necessarily as negative as we saw before. Now, we had some wonderful, great guests this week. We had some wonderful guests recently. Been super appreciative of everyone's thoughts. Next week, we have three fantastic guests for you. On Tuesday, the 15th, David Settle from Market Scholars. On Wednesday, Pat Seresna from Big Picture Trading. And on Thursday, David Auerbach from the Daily REIT Beat, talking more about income-oriented investing. And then coming up on September 22nd is our next big event called Introducing StockCharts ACP. Just sat down this week with Ralph Acampora. We're talking with Larry Williams, Martin Pring, John Murphy, Arthur Hill, Dave Landry. It's been a fantastic group of market experts and people who have participated in our new ACP platform, whether through the vision that they created for technical analysis or for particular plugins that they have created that you can subscribe to right through the ACP system. So we're going to present the new platform, explain it to you, show you how it's part of the overall StockCharts experience, and a lot of great guests to spread the word with us. That's coming up on the 22nd. Let's get to our wrap the week every Friday. Our goal is to wrap the week. That means look Friday to Friday and just see how things have evolved, see what's changed in the last, in this case, 4 sessions. I did want to point out, just start with a poll here very quickly. We asked you recently on StockCharts TV and elsewhere, which industry group do you think has the best performance in the next 3 months? So really going through, almost year end here, going through mid-December, which of these groups? And we gave you 4 choices: semiconductors, home builders, biotech, and banks. And the votes are in. Almost a third of you, the number one answer, semiconductors, the SMH. Second was home builders, around 26%. 26% of you also said biotechs, and then only 16% said banks. So of course, as a contrarian, I immediately go to the chart of the KBE to see if there's something in there. Is this a great contrarian play that I could maybe bet on the fact that this is not a widespread idea? And, I'm not surprised we're sort of self-selecting into a group of trend followers, a group of chart aficionados, if you're answering our poll in the first place. So I think you're recognizing what I am too, which is when you look at banks, just the relative performance has been, essentially flat to down. Really, it's been negative since the entire beginning of the year. We're down 36% from where we started, on January 1st of this year. So it's been brutal, as most things are sort of back, sort of testing new highs or above new highs or previous highs. And here's the KBE down well below its 200-day moving average, down below two downward sloping moving averages. Now, the number one response was semiconductors, which is interesting. If you asked me to respond, I would actually say probably home builders. I don't know though. I get either of those two. I think you could make a good sense for sure. Biotechs have rolled over. I think at this point it's hard to assume that that's going to be the best place unless it's more of a macro play and you're ignoring the chart a bit. I think with home builders, these are the ones out of all four of those groups have really been testing, remaining near new highs. If you look at Lennar, Pulte, and others, but we will see. Semiconductors is a decent bet there. Let's continue on. Let's wrap the week. Look at how today played out, and then let's focus just on the longer term charts. As I mentioned, the S&P flat, but the breadth characteristics have continued to weaken. I think the real story here is the underperformance of small caps relative to large. That's a theme that continues to play out. The strength in industrials and materials. When I talked with Fred Meisner this week, he said his best ideas were in industrials and materials. And so far since Fred's appearance, it's been a pretty decent bet, with those two sectors actually doing meaningfully better than others. Financials were third today. Technology leading the way lower. And again, that's, what I guess the big debate here is this an overall market sell-off that we are in the early stages of? Is this inning one of a 9-inning game that goes lower? Or is this just rotation? And right now, what today was essentially more of a rotation, with industrials, materials doing well, technology doing poorly, and everything else kind of in the middle. But again, this is one day. Overall, the trends are what we want to start to reflect on and start to think through. Let's go to the Mindful Investor Live chart list. Let's take the remainder of our time and really focus on the long-term charts and how they've evolved. We're going to start with the market trend model. This is a model we review every week together, something I've used for a number of years. And, think of it long-term, medium-term, short-term. Long-term is based on the 21 and 34-week exponential moving averages. That turned positive in June, remains positive through now. That wouldn't go negative unless there's a pretty severe sell-off. You really have to change trend for that to sort of signal. The medium term is here. The 12 and 26 week averages is what that uses. That's sort of a traditional weekly MACD or weekly PPO setting. It's getting closer to a sell signal that has not registered yet. Overall, it's still in the positive camp. The short-term signal, and this is more of a placeholder for me, looking at the price relative to the 5-week average. Are we above or below that on a closing basis? And really, for me, the short-term is driven by the daily chart, which we're going to look at in a minute. But I like having an indication just on this chart showing me all three timeframes, and that actually did turn negative this week. Did not last week. It actually held on Friday as we sort of rallied a little bit, but the follow-through that we saw this week really pushed it to the negative side. So when I update these over the weekend, it'll be long-term bullish, medium-term bullish, short-term bearish. And one of the comments I got when I shared this earlier in the week was essentially, if you're waiting for a long-term signal to turn negative, you're going to be waiting forever. You're going to wait until after the markets turn lower. And that's right. That's actually by design. I wouldn't tell you, I don't run a fund or anything based purely on this. I think that's oversimplifying things, to be honest with you. But where I would say is at a market top, at an inflection point, you naturally start looking more at the short-term reads just to understand the short-term dynamics. Because as you said, as you imply by the question, as things roll over, it'll be reflected on the short term, and then the long-term trends will eventually recognize that it's not just a brief pullback, it's more of a downturn. I think that's the scenario we're at, where in the short term, it's now looking weaker rather than stronger. And the question is that enough to pull down the medium trend? And is enough for that to pull down the long-term trend? That's not something we can answer just yet. I think that's something we have to figure out through the course of time. All right, that's the market trend model. Let's go to the next one, which is the daily S&P chart. And as we talked about, this week, I think 3350 was that first sort of line in the sand. We hit that earlier in the week. We retested it again Thursday and Friday. We've now closed below it 3 out of the last 4 sessions. So overall, I think we're really right at that point. It's hard to really think that this is the signal, the trigger, until we get below the 50-day moving average, which we traded below today, but actually closed back above. So going into the beginning of next week, we follow through that, which I expect that we will. I think we'll go further down. I think the real line in the sand for people, this is more of a short-term thing, which I think I've seen enough weakening breadth to suggest we're going to get a little bit further downside no matter what. But I would say 3,200 is really the key line. That's the peak from June. We retested that in July. That's a pretty solid level and a previous inflection point a couple times, that's where I'd be looking for price support. If you're able to hold that, that means you could, perhaps we've pulled back enough that you expect further upside. If not, I think you really have to do some soul searching about the potential for further downside risk. It's never too early to think about what levels we might break that might cause you to revisit, a long positioning or a long thinking. I was on Bloomberg TV yesterday and showed the broadening top, which I'll show you here in a second. It's really the long-term pattern looking at highs and lows. Give me just a second here. Random social charts. Let's see, right down here, SPX. I should have come prepared with this one for sure. But basically, I have a chart that shows the evolution. It shows basically the weekly chart, and it shows the broadening top pattern that we've seen. A broadening top is essentially when you have higher highs and you have lower lows. I'm not seeing it on here it is. There we go. So say I need to come up with a better titling. Yeah. So basically, what I was trying to do. This isn't even the right chart. I'll go back to this one. I'm so sorry. Here at the weekly chart of the S&P, if we look at it, the idea is that you have higher highs and you have lower lows. And if you look at the weekly chart for the last couple of years, since 2018, highs getting consecutive higher, lows getting consecutively lower. And the challenge is, if you connect the high from January 2018 to the high February of 2020, that lines up actually really well from the high we just saw in the last 2 weeks. And the question is, does that mean we go all the way to the bottom of this broadening top pattern, which would take us down to S&P 2100, S&P 2000? I think the chance of that happening is pretty remote. I don't think we would get all the way down there. But if you look at the 1970s, it almost looks like a bit of a broadening top pattern. The way you saw that bear market period was starting to be over was the next low kind of finished up here. It was more of an inverse head and shoulders, yet a higher low. I don't think it's impossible that we get a move back down into these levels, 2,500, 2,400. I think that's possible. And again, the good news is there will be a lot of points between here and then that we would cross and be able to figure out together. But also on the weekly chart, I think the bearish divergence jumps out at me with this most recent upswing that we've seen in recent weeks, really much less momentum on that upswing from what we saw in January. So it really is speaking to sort of that long-term sort of topping pattern. And remember, markets can correct in two ways. It can correct in time and in price. We may just spend a lot of time backing and filling and basically pleasing no one when you go sideways. The lack of up or down direction, we just go sideways, is probably the most painful of the three directions we can go. But again, let's focus on some of the key levels and see how those trends evolve. Let's go to the next chart here. This is looking at the breadth by cap tiers. I haven't completely updated this color-wise. I usually do that over the weekend, but it's worth noting that the common stock advanced decline line broke down this week, basically showing weakening breadth. That's now a pattern of lower highs and lower lows. The mid-cap breadth index turned lower earlier this week. The small-cap breadth index turned down first. Just in the last day or two, this is as of yesterday's close. Today, when we update, I wouldn't be surprised if it's around the same level, if not a little bit lower. And I think all four of these now have broken the swing low from mid-August. So while the S&P has rolled over, I think the real tell is the fact that you saw lower peaks in most of these breadth readings, and now they're breaking through their swing low. And this pattern with higher highs in the S&P breadth, lower peaks in small cap breadth, lower peaks in the New York Stock Exchange breadth, you see a lot of similarities right now with the last 4 weeks of higher highs here and lower highs in all the other readings. So it's lining up with previous bull market tops as well. Looking at new highs and new lows, we talked about this yesterday. I think we really focused on breadth in good deal. And if you missed that, I'd encourage you to go back on our YouTube channel, because we talked a lot about the individual breadth charts and how they were evolving. But what I wanted to point out here was we had a consistent number of new 52-week highs that pretty much evaporated. We're starting to get a couple of new lows, but really nothing. Everything's sort of in the middle. But the signal here is that all the new highs that we've been seeing have essentially gone away. There really isn't anything making new highs this week, especially in the last couple of days. This breadth indicator, looking at percent of stocks above their 50-day, has broken to a new swing low. I think that's pretty telling. It'll be interesting to see if it remains above where we saw in June. This is when breadth was really high. It came down to below 50%. And right now we're nearing that 50% level. We'll have to see how things play out as we lock in today's closing values. It's not in there yet, but that's certainly suggesting a bit more of a short-term top. And again, the difference here is almost 100% of the S&P was above their 50-day here at the June peak. Only 85% were above their 50-day here about a week or two ago, and now it's almost 50%, which means 30% of the S&P has rotated back below their 50-day in the last couple days. This percent above the 200-day, if we remain above 50, that's sort of the longer-term bull market signal. If we break below 50, that tends to make things look a little more bearish. In terms of sentiment, just very quickly, we're going to talk about the name exposure index a little bit later, but just wanted to point out with the AAII ranking, certainly a rotation back towards more of a bearish perspective. And this is, again, the individual investors. It's not a comprehensive look at sentiment, but certainly speaks to how this subset of the investor cohort is voting right now. Almost 50% bearish, outnumbering bulls 2-1, with just big change from the last couple weeks. Let's finish out just looking at some of the ratios and how they've changed, and then we're going to take a quick commercial break here in a minute. Looking at the ratio of consumer discretionary to consumer staples, the ratio is actually holding up okay. The challenge is, if you look at the relative strength of consumer discretionary, it's actually doing very well. Also, the relative strength of consumer staples holding up okay. The big difference is, the equal weighted version clearly favoring consumer discretionary, and a lot of the staples charts, as we talked about on Tuesday's show, really starting to show some pain. That's like KHC and General Mills, a bunch of those. The last one that I noticed, we're out of time. Sorry for missing it here. Semiconductors have rolled over on a relative basis, and I think I actually wrote an article just before the show for our Chart Watchers newsletter, which comes out every Saturday morning, talking about this rotation away from semiconductors, how it lines up with the weakness in the NASDAQ, weakness in the technology sector that we saw again today after seeing that over the last week for sure. Again, it's still a short-term read. It's still telling you the beginning of that inflection point. But if that trend continues lower, really speaks to some weakness from a key group, semiconductors, which tends, in my opinion, to be a good market tell because it's a good way of measuring the overall health of the economy. We need to take a quick commercial break. We'll be back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love hearing from you. Feedback on the show, feedback on guests, who we should have on the show as a guest. All of that is very, very helpful. But most importantly, we love hearing from you, questions you're running into as you go through this process of trying to analyze these charts for your own account, for your own decision making. Let us help you answer those questions and point you in the right direction. Two ways to get questions to us. One is via email, thefinalbar@stockcharts.com. The second is on Twitter @finalbarsctv. Perhaps the third one is on YouTube or anywhere you see our content. Just put a comment below that will capture all of those and put them together for a future mailbag segment. Having said that, let's get to our final bar mailbags where we answer your questions and what you're facing. Let's get right to it. Question number one. Hi, Dave. I love the show. I have a question. In the turbulent markets, how often will institutions rotate in and out of defensive versus offensive stocks? The RRG and relative strength suggest daily rotations, but surely with the amounts of money they have, this would be very difficult. Really, really good question. We talked earlier in this week about the difference between the weekly RRG and the daily RRG. I actually think that was one of my questions from our last mailbag segment. And yeah, here we're looking at the daily RRG, and it's a great visualization right now to show this rotation away from tech, away from communication services into things like materials, industrials, consumer staples. You can see them rotating all in a northeasterly direction. That's certainly how things have felt. The kicker is there's a lot of market cap over here, which is still outperforming. It's over here on the right side, even though it's coming down, it's still further to the right, which means over the longer term time frame, it's still been doing pretty well. These are some of the smaller sectors, in particular materials, industrials are a lighter weight in the index. So the index still holding up okay for the most part. Your question is, how much are institutions really rotating in or out? Well, so it depends on what kind of institution we're talking about, right? There are plenty of firms managing decent amounts of money, billions of dollars, and are relatively short term. And so there is money that's flowing in and out very quickly out of names. And it's not just high frequency firms, hedge funds, many others have the ability to rotate a little more nimbly in their businesses based on short-term fluctuations and taking advantage of some of those short-term moves have a relatively short time frame. When you're talking about a longer firm, like a mutual fund company, a pension fund, a retirement plan, something like that, where you're managing really for the long term, the biggest struggle I had working at a larger shop like that was our inability to be nimble. One adjective I would not ever use to describe the way we were able to manage money was nimble. We were the Titanic, and we often talked about, nudging the ship 2 to 3 degrees in the right direction, because if you're managing a $50 billion fund and you want to accumulate a position in a particular stock, that could take days to weeks to accumulate a meaningful position. So you're really unable to do it. Having said that, one of the biggest challenges you would have is if you actually did want to put on a trade, you wanted to do it in a way that would minimize its impact on the trading of the stock. And if someone saw a huge buyer coming in with a lot of demand, you'd get burnt as people would try to front run what you were doing. So a lot was done to try to, make things anonymous and try to cloud what was happening to make sure that we were able to get filled when we needed to and accumulate positions and get out of positions without completely, messing up operation of a market in the process of doing so. So I would say that there are times when big funds will have to get in and out, and that will cause plenty of demand or supply to come in very, very quickly. And so some of the short-term rotations you will see will be the beginning of some of those moves. But broadly speaking, yes, it was very hard to be nimble. And yeah, in general, at a larger firm, that's the more zeros you have in the account, the more challenging it is to actually make those short-term movements. Question 2, thank you for all the guidance. You're welcome. I'm currently looking at cycle theory and analysis. Whoa, when do you, if ever, incorporate spectrograms and Fisher transforms or other cycle tools in your stock market analysis? It's a great question. So short answer is not very much, but you're grouping a bunch of other things into cycles. So the general idea of cycle theory, I would say that there's a whole cyclical nature to a lot of things in life. It goes with the seasons and cyclical nature of a lot of companies and their business models. So that is, I would say, cycle analysis is based on the repetitive patterns that occur naturally with financial markets and also occur naturally with a lot of other things. And I think there's no denying that there's a cyclical nature to things. And while I am not, you don't see me referring to cycles a lot, anytime I've been, able to talk with others that look at cycles has been very important to me. I think, talking with people that do GAN analysis, again, I'm not a GAN person, I'm not a GAN analyst, but I find a lot of value in talking with people like that are focused on the price and time relationship and looking for cyclical patterns. So I think there's no denying that there are fluctuations in the market, and you can find some ways to automate it. I have not, I've looked at things like spectrograms. You're talking about like a Fourier transform and ways of trying to different ways to, allow computers to help you do that and help you identify cycles. For me, it's been less about cycles and it's been more about trend. And I think that's the big difference, right? When cycles come due, it's all about the trend and potential trend reversals. And I've often found, for me at least, cycles are interesting. I think cycles are fascinating, but if a trend is in place and a cycle comes due, I'm much less likely to change a position or change an outlook based purely on the fact that a cycle's there. I'm going to look for the price to move. So I feel like my toolkit of trend following is able to help me with that. But having said that, please dig into everything. I think a well-informed investor has gone through that journey of finding things that you find value in and finding things that don't need to be in your toolkit anymore, and that's great. Question 3, I can't figure out why materials, the XLB, has huge outperformance to energy XLE on a long and short-term basis. And you sent this chart. Thank you for including a chart. Here it is. Seems like they should both be inflation, reopening, positive economy, that sort of trade. Just a really interesting chart for me. It's a really good point. So this is the chart of the XLB versus the XLB. So this ratio going down is showing energy's underperformance relative to materials. You've heard me probably say randomly, I'll talk about the MEI trade, the late cyclical trade. That's materials, energy, industrials. These are sort of economically sensitive sectors that tend to do that. Those doing well tend to speak to the economy in good shape. Those doing poorly speak to the economy not in good shape. What's happening now, though, if you look at today's just today's movements. You have the M and I in the MEI trade up at the top. The E is down here sort of flat for the day, and most days it's been down here at the bottom. So I think, again, I tend to group them all together, and then in over market history, you'll find that tends to happen. There's a disconnection right now, and I think that's related to, sort of a coronavirus thing. Things like materials, industrials are showing that there's optimism, showing that there are opportunities. I think the weakness in crude oil prices, the oil producers having to cut, pricing and all of that is speaking to a huge evaporation of demand. And although we're still buying products, we're not driving around and doing it. And I think, again, it's more of a consumer demand for energy that's really the big difference here. So you are right in saying, in general, over the long term, that's a decent grouping. But right now, I'd be focusing on the individual trends. And you're right, materials, industrials looking pretty well and emerging well. Energy, absolutely not on a relative basis. The last question, and then we need to wrap the show. This chart seems pretty short term. What's your exit strategy for the SMH? And you referred to this one. This was something that I talked about earlier, and I got this question. This is the article I wrote for Chart Watchers, really gets to this. So I'd encourage you to read that. And if you don't subscribe to the Chart Watchers newsletter, go to StockCharts.com. You'll see a link to subscribe for it. It's really, really good because it includes articles from all the StockCharts contributors. We all weigh in at times and sort of give our latest thinking. But this ratio, for me, price is king, as we've talked. I mean, I think I've said that probably often enough, that price is the number one thing. So your main goal as an investor is to analyze the trends, to understand the trends and track them, follow them, and then find some ways to anticipate when those trends are reversing. And arguably, I think we're at one of those points where an uptrend in stocks is revolving or evolving into a downtrend in stocks. We're seeing some different markers along the way that are helping us make sense of it. So the main way I would determine whether or not the S&P is going up or down is by looking at the price of the S&P and analyzing it. But there are secondary things like sentiment, like breadth, like ratio analysis, which start to speak to the character of the market and speak to internal strength or weakness or where people are starting to rotate. So while I'm thinking about the overall health of stocks, this ratio for me has just been a good general sense of economic strength. I think my theory would be when the markets are doing well, when people are buying products and the economy is functioning well, demand for semiconductors should be going up, and the companies that produce them should be doing pretty well. That is the general thesis, and it's really not that long-term of a thesis. It's relatively recent because of the how these are proliferated around pretty much everything we do is driven by semiconductors in some way or another. So the fact that this key group is rolling over, while not a trading system, in my opinion, certainly speaks to the potential of leadership rotation. I think the charts of the XLK and others are where you'd really see that breakdown. The relative strength of the XLK, the price of the XLK breaking down through key levels, looking at the SMH as a pure analytical tool would be helpful as well. For me, this is more indicative of some potential rotation. Those are our questions. Those are really good questions, really kind of thought-provoking. I enjoyed sort of thinking through those and sharing answers with you. So I appreciate you sending them my way. Let's wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the materials sector. It's worth noting that the relative strength on this has spiked pretty well. As we've talked about, energy, certainly the weakest of the 11 on a relative basis, and materials, while not the strongest, I would say that would be reserved maybe for consumer discretionary at this point, maybe industrials, I don't know. Materials are a close third. Materials are sort of a rounding error. If you look at its weight in the S&P, it's only a couple of %, but includes some key groups that are actually doing really, really well. So while a lot of sectors, a lot of indexes have rolled over, materials are actually holding up okay, and on a relative basis, making a new, almost a new 12-month relative high today. Chart number 2 is the name exposure index, and this is the black, the gray bars that you see here. You can see that this was up above 100%, meaning active investment managers were essentially all in. That has come down. That's been halved to just about 50% just in the last 2 weeks. So that shows you, I think it speaks to the euphoria and the extreme bullish positioning that we had and how quickly people are fearful and heading for the exits. Finally, the chart of gold. I did an interview earlier today for Palisade Radio. It's a really good podcast. We talked about the chart of gold. I think it's pulled back to key support, and I like where the GLD is sitting right around 180, right around the 50-day moving average. You'd like to see that hold and see if there's potential for gold to ride the next wave higher. Folks, that's our show for today and a wrap for this week on the Final Bar. Thanks so much for joining us every weekday for our show. Get your questions to us at any point, thefinalbar@stockcharts.com. For all of us at StockCharts TV, I'm Dave Keller here at StockCharts.com. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.